high, and everybody's waiting for Janet to drop the bomb, you know?
It's the Nasdaq 100 that is at the 15 years high, so there are 100 shares in the Nasdaq 100, and it's not above the level of year 2000, March 2000. It's just a tad below that level.
Right.
I mean, it may go up. You understand? The composition of an index is that it's usually capitalization weighted. Right. So one stock that goes up vertically could theoretically drive up an index, and 99% of the shares don't make new highs. It's like yesterday we had a very strong day on Wall Street, but on the New York Stock Exchange, out of more than 3,000 shares that are being traded, only less than 100 made a 12 months new high. So the advance is very narrow. And if you take the whole world, then it's very few shares that are making new highs, and the majority of shares are down already 20, 30, 40%.
Yeah, because size does matter in the markets. Those with big market cap, if they have a good day or whatever, it completely skews, it skews the action, doesn't it?
And we see actually the same action in the art market and in the property market. Some markets are still strong, but the bulk is no longer moving up. So in other words, the advance of asset price inflation has been narrowing significantly.
But the fact that you say that a lot of the market is down, you know, not reflected in these narrow indexes, especially the Dow. The Dow is the worst index in the world because it's only got 30-something within it. Does that mean that the crash is over already? It just doesn't show up?
Well,
we don't need to worry?
I don't think the crash has happened yet. That's the good news. It's still ahead of us.
That's not, and that's good news?
Well, let's say you're a young person and you're just starting to work. Say, take me in the 1970s. In the US, with 20 hours of work, I could buy an S&P 500. Now, you need more than 90 hours of work to buy an S&P 500 if you're young, say median income. You buy homes. When I was young, you could buy a home at a reasonable price, even in Hong Kong. Today, prices are up in the sky, as you should know. At the time, in the 70s, I could buy government bonds in the US, treasury bonds. They were yielding 6%. Throughout the 70s, the yield went from 6% to over 15% in 81. So not being very smart, you and I, we could buy bonds, and the compounding effect made us relatively wealthy. A young guy today, he buys in Europe bonds or in Japan, the 10 years in Japan, is at 0.3%. In Europe, there are over $2 trillion worth of bonds. They have a negative yield. So in other words, you buy them, you're bound to lose money over time. Maybe you lose less than in stock. What I want to say is the Fed has basically created a gigantic, with their colleagues in Japan and at the ECB and the Bank of England, they've created a colossal asset bubble.
And
the returns going forward are going to be disappointing.